um, which is a continuation of what we've done in the previous classes. So the financial terms we'll do it, and then we'll come to the economics related topics. What are there? So we will take it up about the monetary, fiscal policy, and the other things. But first, little simpler on this side. I mean, let's take up the next topic, which is sources of finance. What are the various sources of finance? Okay, so let's start. Broadly classifying, we can classify the sources of finance as the amount which is invested by owners. So this part, the first part of it is the amount which is invested by owners, and another part of the investment is the one which is invested by outsiders. Outsiders, or we also call it as others. They do not have their ownership right in the business, but they have some benefit here. So outsiders. Then again, we can subclassify them as owners amount is classified as one umbrella term, which is called as equity. So equity, under that again we have different types of equity. Then then we see that equity could be ordinary shares, okay, and then we see that there is another type which is called as internally generated, or what we call it as retained earnings. So this is also another source of capital, source of finance, which is available for investing in the business. So we see that sources of finance, we see uh, owners and the outsiders investing their funds in the business. Under equity, we see that there is one thing called as ordinary shares. Okay, another type of shares also is called as preference shares. Okay, but then that's categorized under the others. Okay, under the others because they cannot participate in the decision making of the company. They have their preference in terms of something, so they are categorized under others because they are not the owners with decision making powers. Fine. So under the broad term equity, then we see that ordinary shares, and then we see that internally generated retained earnings. I will explain to you what is the concept of retained earnings. Then we see under the others category, um, we have long term sources, we have medium term sources, and short term sources. Sometimes there is some benefit which is received from the government grants, special purpose, example government grants, or certain other things wherein some subsidies are given, or those benefits which are received. Okay, so when we look at this particular uh, classification, then we understand that uh, the ordinary shares and till here the under the long term category, whatever are traded in the stock market. Now we see that they are traded in the capital market. The ordinary shares, we see the preference shares, we see the debentures or bonds. These things are traded in the capital market. Then other sources from outsiders, which are both medium and short term, they are traded in the they are available in the money market. Money market is a market where the financial instruments have a lifetime of 1 year or less than that. So based on the time criteria, we categorize them into money market. Okay, for a very short period to a period of 1 year, we see that this in financial instruments are traded. Capital market for a very long period of time. That is sources of long-term finance. They um, some of them are not redeemable at all. Some of them are redeemable in a long period of time. Now, what about this retained earnings? So I will quickly take you through one. a format of income statement. I'll put it in the we see from sales the Excel sheet is not opening. I thought I'll put the format in the Excel sheet. It's not opening. Um, I'll do one thing. I'll put it in the um, Word file. I hope you're able to see the Word file screen.
Yes, ma'am.
I want you to make a note of this format of income statement. First, we begin with sales. Then we have less cost of goods sold. Then we have gross profit. From the gross profit less operating expenses. I'm not touching on the otherwise. Uh, why take a risk? This is called as operating profit. Then we deduct less non-operating expenses. Then add non-operating incomes. This is called as EBIT. The first thing is less interest. Then this is called as EBT, earnings before taxes. Then less tax. Then we call it as EAT, or what we know it as PAT, profit after tax. Less preferred dividend. This is net income available to ordinary shareholders. Less equity dividend. Okay, I know you are aware of this income statement format, but it is important that we have to stress upon this one at this point of time. So, for that reason, I have written this format on the screen. We understand sales minus cost of goods sold is gross profit, operating expenses, non operating expense, and incomes are adjusted. So, we start with EBIT. So, our starting point is from EBIT. So, if we are looking from EBIT, EBIT is the profit which is available to all the investors. So this is the profit available. Out of this, the first preference is given to interest. Interest is deducted. So interest is the return which is paid to the outsiders or the debt holders. So the first preference is to outsiders. They are given, they are paid interest at a fixed proportion, fixed percentage calculated on the face value of the debt capital. So they have the first preference in terms of payment of their return. It is an obligation. So the debt capital which is raised is usually to be repaid after a period of time. So the period is very specific, and moreover, they are also entitled to receive a return which we call it as interest, and uh, this is irrespective of whether there is a profit available to pay the interest or not. Whether interest is paid or whether profit is available or not, interest has to be paid. So it becomes an obligation for the business. So EBIT minus interest is called as EBT. So earnings before tax. Then from that, less taxes. Okay, less taxes. We see that earnings after tax or profit after tax. The next preference is about the taxes, earnings before tax, and then we see less taxes. And then the resultant figure is, after the liability to the government is also met, the resultant figure is profit after tax. So this is the profit after tax available to both the types of shareholders. There are two types of shareholders: the preferred shareholders and the ordinary shareholders. Preferred shareholders, they are paid a dividend next. So this is the total amount of profit, but out of that, the preferred shareholders are entitled to only a percentage of dividend. Their percentage of dividend is also fixed percentage, and fixed percentage calculated on the face value of the preferred capital will be the amount of preferred dividend. So between the two of them, that is the preferred shareholders and the ordinary shareholders, preferred shareholders are given the first preference. So finally, after deducting that, we see that the remaining profit which is available belongs to the ordinary shareholders. So from the ordinary shareholders amount, whatever is available, the next one is equity dividend is paid. How are they paid? Is there a fixed percentage? There is never a fixed percentage. Usually every year in the annual general meeting or the meetings which are conducted to take decisions about the dividend payment, a decision would be taken about how much amount of dividend, equity dividend will be paid. um, this amount of profit which is available, net income available to ordinary shareholders, this belongs to them, entire amount belongs to them, but not necessary that it is completely distributed to the ordinary shareholders. There are situations where they are all distributed to the shareholders. The complete 100% amount is distributed to shareholders, or we see that only a part of the dividend is distributed to them as equity dividend. They are not distributed 100% dividend. So the rest of the amount is retained. So we see that only a portion of the profit which is available to ordinary shareholders is distributed, which is called as equity dividend, and the remaining part of it is called as retained earnings. Earnings which are retained, earnings that belong to the equity shareholders are retained in the business. The intention is to see that if at all, if they need additional capital or any additional sources of finance, additional finance amount, instead of looking at other sources of business, they can always depend on this amount which is retained. But technically, when we look into that, this is the amount which belongs to the equity shareholders. So it would be considered as a reinvestment of the equity shareholders amount into the business. So this amount is the reinvested amount of the ordinary shareholders. So instead of distributing to them, only a part of it is distributed. The remaining part of it is retained in the business, distributed and but no matter what it is, this completely belongs to them. So in case of sources of finance, when we started looking at that, we were looking at internally generated profits, the profits which are available but are not distributed. So they are retained in the sense, it conveys a meaning that it is used for reinvestment. So the ordinary shareholders are reinvesting this amount of profits as investment. So that is also, now that would be there in the business as long as the business exists. So henceforth the the ordinary equity or the ordinary shareholders will get dividend on their originally invested amount, and also dividend on the retained earnings. So the, because retained earnings is their investment invested into the business, so reinvestment is also will earn profits. So that additional profits which are earned on that dividend which is available, that also will be paid to the ordinary equity shareholders. So ordinary shareholders are ordinary share capital is the amount which is collected by way of issuing the shares to the public. Apart from that, periodically some profits which are retained in the business but not distributed to the ordinary shareholders also acts as a form of or a source of finance which can be invested into the business. Completely, we see that that is the ordinary shareholders amount. Fine, that is not traded in the stock market. It is there in the business, it belongs to the ordinary shareholders, but we see that the bracket is not applicable for the capital market. They are not traded. That amount is collected not from stock markets, not from securities market, but it is generated internally because the profits were not distributed to them, but they were retained in the business. Okay, I hope I'm clear. Then we see the long term sources are debt capital which is raised. Yes, Ashley.
Ma'am, so in nutshell, can we say that when we talk about equity, that include both the ordinary share capital and the retained earnings?
And also we have preference share capital also under that. That's why I said this equity term is an umbrella term. So under that we have the ordinary share capital at par value, ordinary share capital, any premium collected. Then we have a preferred share capital at par value, preferred share capital, any premium collected. Then all types of undistributed profit, all types, whether it is not only in the form of retained earnings, we have various terms which are set aside for various purposes: P&L account, general reserve, reserve fund, anything which is not distributed but set aside for specific purposes. We see that there are profits which are aside to meet some purpose in future. So until it is that purpose is met, any profit which is set aside also comes under the category of equity. So all of them are a part of equity, so that also comes under equity. Why are we differentiating ordinary shares and ordinary shares and preferred shares? It is one point is, yes, they do not have a preference in terms of equity dividend. When we look into that, at the time of payment of dividend, preferred shareholders are given a preference, yes. But what benefit do the ordinary shareholders get? They have the voting rights. So ordinary share capital, when it is collected, they have the uh, uh, they get the voting rights. So vote with the help of voting rights whenever meetings are conducted or decisions are taken. At that time, they can exercise their voting rights and vote for the decision. So voting for a decision is allowing them to participate in the decision making. So they are participating in the decision making. So kind of they are the real owners. So that is the advantage ordinary shareholders have. Preferred shareholders have only preference at the time of payment of dividend. Okay, so all these terms come under, yes, the way you have said, yes, we have all these terms which come under the category called as equity. Equity is a broad concept. Equity, under that we have all these things. Okay,
Okay, ma'am.
then others we see long term sources which are raised, the debenture capital, or we also call it as bond capital, by selling bonds or by selling debentures, amount of finances which are raised. They are entitled to receive a fixed percentage of interest periodically. Okay, fixed percentage of interest periodically is received, and they are the ones who get the first preference. So out of the available EBIT, they are paid first. What in case there is no profit available? In spite of that, also it becomes an obligation. It becomes an obligation to meet their cost of capital in the first thing, because they do not participate in the decision making. They cannot participate in the super profits which are available. Whether profits are not there, they receive a fixed interest amount. When there are super profits, very high profits also, they receive the same fixed interest amount only. They cannot participate in decision making. Their capital has a term period. Even if it is a very long period or a short period, we see that at the end of the term period, the amount of capital which is raised is paid back to the um, debt holders. Okay, so debt capital, preferred capital, ordinary capital, all of them are traded in the securities market, in the capital market. It's a long term source of finance. Then we have, apart from that, short term sources, also medium term sources like leasing and hire purchases. Then short term periods which are um, like examples are given here on the screen. We see that short term trade credit is accounts payable because of trading, because of buying and selling. If there is any credit facility which is extended, accounts payable. The other day also I've discussed that a major part of short term finance is always from the accounts payable. A major part of the credit facility is extended by the creditors. Then banks also provide overdraft facility. Okay, anything which is raised for a short period of time comes under short term sources of medium and short term finance. Then we see special purposes, some grants and subsidies given by government also as a benefit, is also a source of finance. So anything which is extended by the government for some special or specific purposes and all. So these are the various sources of finance. Then the ordinary shares, the shares, basically shares are um, issued to the public. So public are invited to come forward and invest in the company. So the total capital amount which is required by the company, instead of asking only one or few people, more number of investors are called in to contribute small portions of the amounts, which we call them as shares. And when they come forward and contribute to uh, the capital, they purchase the shares from the company. Then we see that when these shares are purchased from the company, they become the owners of the company. They contribute to their capital to the, and they are entitled to receive dividend periodically. Okay, that is the procedure. Now what is the procedure? There are so many formalities. First, they have to first identify that there is a need for this. Then they have to plan for an issue of share. A prospectus has to be prepared. Then they have to mention the terms and conditions of that. Then they call in for the general public. They contribute their capital, not all at once, but first they purchase the application form. Then a way in which they are uh, approved, and then they are allotted the shares, and then they contribute the remaining part of the capital, and then how it happens. So when the company goes in for issue of shares, and through an announcement, prospectus is issued, there is an advertisement asking the general public to come forward and invest in the company. See, if it is a well-to-known company, very profitable company, if it comes in with an issue of shares, then investors are, because they can they know their profitability position. They understand that by investing in such a company, it is profitable for them. So they come forward. They come forward and invest their amount in such companies. But let's say that not all companies are profitable, well to know companies. Some of them are still in the early stages. Fine. Maybe they cannot vouch for their profitability position. They may not have a very great account of earning high profits in the past periods. So there may be so many issues. See, not a well to known company, if it comes with an issue of shares, many investors do not come forward. So here in this case, some way they have to be motivated to invest in that, so they take help of other sources also. Okay, so the first one is placing new share issues. If it is generally, it is an offer for sale. When the advertisement comes, when the procedure begins, the investors come forward, apply for these shares, buy the shares, and the company allots these shares, and the rest of the procedure follows. But if, let's say that if the company is not a well-to-known company, so they take the help of some others also, like a financial institution or a bank. So what do? They place all these things, all these shares with the bank or a financial institution. So all these shares are allotted to them, and then the public, the general public, can approach the bank and take it from the bank, and then um, purchase them. So placing will be um, for smaller amount of share capital. Okay, um, up to 15 million dollars or so. So it is not huge in capital, but smaller amounts. So these are placed with financial institutions or the banks and all. They have to approach, the general public have to approach these financial institutions or banks, because they're placed with them, and they have to purchase from them. So first thing what happens is, the financial institutions, they pay for the amount to the company, whatever are the shares, and eventually these financial institutions, these shares are sold by these financial institutions to the general public. So they are acting as a, I mean, they are kind of providing a security to the company that all these shares are taken up by the financial institutions. So when an issue is there, all the shares or a major part of the shares have to be subscribed by the general public. That is one of the conditions. So here in this case, by placing them, because it is not a well to known company, or generally the investors interest is not in investing such things. So here we are saying that these shares are placed at another source. So that is some other intermediate source, they are placing that, and from there the amount is collected by the company, and the middle entity, that is the financial institution, later on sells these sells these shares to the general public who wants to purchase. So instead of directly approaching the company, they have to now approach the financial institution. That is um, placing of. The next one is offer for sale. Offer for sale is generally asking the general public to come forward and purchase the shares from the company. So that is a offer for sale. Then we see the next one. The next one is offer for sale by tender. Okay, offer for sale by tender is um, here some profitable companies, let's say that well-to-do companies come forward for issue of shares. So in that case, because of the credibility or the profitability of that particular company, we see that more and more investors are interested to purchase shares from such companies. So if that is the case, we see that the demand rises for such companies. So when the demand rises, the price also rises. This is an exception to law of demand. Stock market is an exception to the law of demand. So when in this case, we see that if the demand rises, we also see that the price rises. So um, if more investors come forward to purchase these shares, the demand, when it is rising, we see that price also rises to encash on that benefit. So to have a benefit of that, benefit of receiving more amount of share premium because of the rise in the demand, the company goes in for selling these shares by tender. Tender is, they do not fix the price. The par value of the shares is not fixed. So shares are generally issued to the I mean investors or the subscribers. Um, but normally the price, that is what is called as the par value, the face value of the shares is decided. If the investors want to pay more than that, yes, the par value would be there, and the rest of it, any excess amount more than the par value is called as the premium that is collected. But here they do not even fix the par value. So whatever is the highest price which the investor wants to pay, now that will be allowed as a tender which is submitted by the investor. So whatever is the price at which they are willing to purchase. So once they submit the tenders, the ones who have quoted higher prices will be allotted. So that is how. So then they would have a they will eliminate all of them who have quoted very less price, and they then decide the minimum limit, and those who have subscribed any thing above a particular value, they are only considered for allotting the shares. So that is offer for sale by tender. So the investors are asked to or called in to submit their tender quoting the price. Okay. So whoever quotes higher price will definitely be allotted the shares, and the ones who have quoted very less price, then their applications would be rejected. Okay. Then some of them lower price. See, not all of them can quote at the highest price. Between the limit, which is lower limit, and the highest value, the others will be allotted maybe proportionally, not whatever they have subscribed for, all of them, all the number of shares may not be allotted, but proportionately the remaining, the rest of them can be allotted the shares. So that is offer for sale by tender. Then we see there is another term called as intermediaries offer. Intermediaries offer. So intermediaries, the term itself says that there is an intermediary here. It is not that it is directly uh, issued to the general public. Yes, we have seen the first one also. They are placed at an institution. Here in this case, intermediary issues would be there are middle we see that there are intermediaries which are present in between the in between the company and the general investors. So they subscribe for all of them, and then they immediately, whenever the demand rises, they sell it at a higher price. See, with the financial institutions, the first part of it, placed by an order, the resale possibility may not appear immediately, so they have to wait, they have to hold on to that for some period of time. But here in this case, these intermediaries, when they purchase it for some commission. So brokerage or underwriting charges are collected by these intermediaries, because they are ensuring that everything is subscribed to. So they are paid some brokerage charges. So the company is assured, the company need not wait until the last share is subscribed by the general investor. So the company is assured that all the shares are purchased by the middle people, that is the intermediaries, what we call it as the underwriters or the brokers who are present in the stock market. It could be a financial institution, it could be an investment bank, the brokers who are present, anyone, they purchase that. So what is their intention? Their intention is, they at the time of issue, the price is not very high, so they purchase it at the face value or a little higher than the face value, but they wait until a period when the demand rises. Once the demand rises, the price also rises, so they get benefit in the difference between the, that's the capital gain which they receive, the difference between the price at which they have purchased and the price at which they are able to sell it to the general investors. So they make some commission, they make some profit there. Yes, they also receive some commission from the company. So the company is assured that yes, all the shares are subscribed by these underwriters or the intermediaries. Then we see the rights issue. Okay, what are rights issue? Rights issue is a new issue of shares, but they are not issued to the general investors, the general public, but they are issued to the and allotted to the existing shareholders. It's only to the existing shareholders that these shares are allotted. Existing shareholders have the right to subscribe to the new shares in proportion to their existing holdings. So whenever there is additional capital requirement, the company can go in for an issue of right shares, and they are not allotted, they are not um, offered to the general investors for subscribing, but they are directly allotted, or they have um, they are made available to the existing shareholders for subscribing. So when we are saying that they have a right to subscribe, so there is also a possibility that some of them may not avail that. Of course, it is, that possibility is there. So when new shares are issued, so why would the company want to go? If it is let's say that if it is a general issue, then they have to go in with the preparation of prospectus, the procedure, the underwriters have to be paid, the commission, all those things, the formalities have to be, and it is little costlier for the company. But when there is a rights issue, they need not go through all this procedure. Right, straight away they can ask the existing shareholders to um, uh, subscribe to these new shares which are issued by the company. And how are they allotted is proportionally. Whatever is the new capital amount and existing capital, existing shares proportion. So each investor, how many shares do they does he hold, taking that into consideration. So all the shareholders and the shares which they hold, so that proportion is calculated, and proportionally the shares, new shares are allotted to the existing shareholders. So the price would be, theoretical ex rights price is calculated as value of existing shares plus proceeds from new issue. So that's the total capital. They have already subscribed to the old shares. They are the existing shareholders. So value of existing shares plus the new amount which they would be collecting from the issue, divided by the total number of shares in. Uh, shares in issue after the rights issue. So here the press proceeds from new issue. Here we see the second part of it. Now this is not, generally we see that this is not on par with the market value. It is less than the market value. Since the company is saving certain costs and it is already to the existing shareholders, it would not charge the same price what uh, the price is prevailing in the market, but we see, generally see that that is at a reduced value, less than the face value, uh, less than the fair market value, less than the fair market value. I'm really sorry, I said face value. Less than the fair market value. So the price which is prevailing in the market, it is not at the same price, but at the lesser price. So altogether, for now, the total number of shares in issue after the rights issue. So they have their old number of shares plus the new allotted shares. So new number of shares also, the total number of shares. So in the numerator, we have the old share value which they have subscribed plus the new proceeds from the issue, add them up, divided by the total number of shares after the rights issue. So that is called as the theoretical ex rights price. The price after the rights issue is made to the existing shareholders. What is the value of a right? Value of a right is equal to theoretical X rights price minus issue price. Okay. Um, so value of a right per existing share is equal to value of a right divided by number of shares needed to have a right. Number of shares needed to have a right. Then they calculate what is the value of a right per existing share. So proportionately, so how many ever shares they have earlier subscribed. So based on that, how many new shares should be allotted. So value of a right per existing shares. So proportionally, they are allotted these new shares. So that is another way of issuing share capital. So new shares, the entire share capital, the shares are placed with a financial institution is place offered by placing. Then we see offer for sale. Okay, generally, the investors are asked to subscribe to the shares which are issued by them. Then, when the demand is more, then they open up the price by asking the public to submit their quotation in terms of what is the price. So, they are asked to submit their tenders quoting the price of that, and then they decide on what is the maximum price. They are allotted 100% shares, and the minimum mark is set, and below that all those who have presented their share price are disqualified, or they are not allotted anything. And in between these two, we see that whoever have subscribed, they are proportionally, or only one portion of the whatever they have they have applied for is allotted. So proportionate few shares are allotted to the rest of them. Then intermediaries offer, some intermediaries come forward to purchase all the shares from the company when there is an issue. So, as against that, they also charge some commission, or what we call it as underwriting fees or brokerage commission or something. These are the terms. So they also collect because they are uh, subscribing to all the shares immediately. The company is assured of their share capital. Later on, they wait until a time where when the demand rises for these shares, and then they sell them again in the shares securities market and make a profit there. Okay. And then the rights issue is to the existing shareholders. These shares, when they are issued proportionally according to the shares which they are already holding. Then we see what are the differences between debt and equity. There are two major aspects which have to be. Did I explain recently anytime? Debt and equity? No, I didn't. Uh, so debt versus equity. Equity shareholders own the business and have voting rights. Debt holders are higher in priority for payment than the shareholders. Then we have the risk part of it. Then we have the return part of it. Um, we'll put it in a simple format. So we see that outsiders, also called as debt holders, is one type of investors. Then we see another type of investors called as equity. Debt holders and equity holders. So then we see um, they are outsiders. Already we've discussed equity or the shareholders are the owners. So they have a preference at for payment of interest. They are paid last. Okay, this is at a fixed interest percentage. So this is called as at a fixed interest. There is no fixed percentage. Um, but they are paid their return, which is called as dividend. So this is there is a fixed interest, and this fixed interest is always an obligation. So they do not have to check whether profits are available or not, irrespective of the profitability position. Their dividend amount is their interest amount is paid. I'm really sorry, their interest amount is paid, and the return what is paid to the shareholders is called as dividend. Okay, fine. The important attributes what we need to look into. What do we have to look into as important attributes is what is the cost part of it and what is the risk part of it. That is what we have to focus on. In case of cost, in case of cost, debt capital is cheaper. So cost is less in case of debt capital, and we see equity is costlier. The cost of equity capital is high. Then, when we look at the risk aspect, the risk is high in case of debt capital, and then risk is low in case of equity capital. How do we figure it out? Okay, the cost is less. Generally, debt capital is issued uh, at an interest rate which is more or less according to the prevailing interest rate in the market. So at the time of issue, let's say there is an issue in year 2021. So whatever is the prevailing interest rate, more or less it would be fixed at that, depending on other ways or other parameters also which are considered for deciding what is the interest rate. But in simple terms, we can understand that it is the prevailing interest rate in the market. So at that rate, when the interest is fixed, and this holds good until the end of the life of the um, debt capital. So let's say that if the debt capital is for a period of 10 years, and if assume that in 2021 the prevailing interest rate is 5%. So when it is decided as 5%, this 5% holds good for the next 10 years. There would be no change in the percentage of interest. It's the same percentage of 5% which will be applied until the last year, until the end of the life of the debt capital. The same percentage is applied. Even if the market in the market the interest rates vary, the prevailing interest rate could be anything, but there would be no change made. Okay, so in that context we see that debt capital is much cheaper. Okay, but it is the risk is quite high. There is the type of investment. When we look into that, we can call that debt capital is riskier than equity capital. The risk is high in case of debt capital. Why do we call that risk is high in case of debt capital? Is there are two important points. One is periodically they are paid interest is first point. Second point is there is a term period. At the end of the term period, the amount has to be paid back. recently, yesterday and the previous class, we were discussing about the working capital. So we see that funds are already invested into current assets or long term assets. So funds are not available to make the payment. So on that note, we have to understand that it is not it is not that the funds are available, that at the end of the term of the debt capital, funds can be repaid to them. So um, because they are already blocked into long term assets, they are blocked into current assets, converting them into cash is a problem. So there they see the risk. And because interest is an obligation and it has to be paid irrespective of their profitability, then to make the payment of interest, to make the payment of the or to redeem the face value of the debt capital, since funds are not available, they have to go in for raising other sources of finance. So on that note, we see that debt capital is riskier. The risk is high in case of debt capital. But because equity, we are not saying that dividend is a fixed dividend. When funds are available, dividends are paid. When funds are not available, dividends are not paid also. So the company doesn't feel the obligation to make a payment to the shareholders. So that's one important point there. And there is no maturity period. As long as the company exists, the debt, the equity capital um, lies with the company. So they are under no obligation or no rush to repay the amount, because there is no term period for the equity capital. So on that note, we see the risk is low. Okay. So coming to the cost part of it. So we are seeing that the company is not under any obligation to make the dividend payment. But important point, if the shareholders, the existing shareholders are not satisfied, why would they not be satisfied? They would not be satisfied because there is no amount or a proper amount of dividend paid to them. Okay. So if they are not satisfied, then there is a chance that they may withdraw their investment, that is they can sell their shares to other investors in the stock market. So that danger is always there. So once that happens, then they sell away their shares in the securities market. If that selling pattern or that trend picks up in the stock market, more and more investors, more and more shareholders of the company start selling away their shares to others. So when the demand falls, the price also falls. When the price falls, the market value of the company falls. Then the external stakeholders will not be willing to be associated with the company no longer. So that is the danger which is there. Fine. So to satisfy the shareholders, to see that they do not withdraw their investment, they do not sell their shares in the stock market. So on that note, they are always under that pressure to satisfy them. To satisfy them, the best way is to earn maximum profit. So the profit which is earned belongs to them. Only when there are higher profits earned, they would be satisfied. That is a different story if they are not paid 100%. Even if they are not paid 100% dividend, yes, it belongs to them. A part of it is still there in the business, called as retained earnings. So but ultimately it belongs to them. So to satisfy the shareholders, a higher rate of return has to be earned by the company. So that increases their cost. Whatever profit, whatever return they are earning, that has to be paid to the investors. So the return earned is the cost of capital for the company. So the cost of capital in case of equity is high, because um, this amount will become a cost for the company, which has to be eventually paid to the investors. So on that note, we see that the cost of equity is high. The debt capital for the debt holders, from the investor's point of view, investor is assured of getting an interest amount, assured of getting back his uh, investment, total investment amount, invest interest and investment, both of them the debt holder can get back from the company. But when we are looking from the perspective of a company, for the company risk is high. Why? Because periodically they have to meet the interest payment, and at the end of the term period they also have to pay back their amount, the face value or whatever are the terms and conditions. According to that, the amount has to be paid back to the debt holder. Okay. But in case of equity shareholder point of view, he has high risk. High risk is, if the company chooses not to pay any dividend, they would have no return in that particular period. Of course, it could be deferred. Later on, the total amount will be paid back to them, but then they have to wait until the winding up of the company. So, in the current period, they are not receiving anything. So, for a shareholder, the risk is high. But from the company's point of view, the risk is low. And shareholders cannot get back the amount from the company. For that, they have to again approach the stock market and trade their shares in the stock market. But it is not possible to withdraw it from the company. Fine. High risk for shareholders, and it is low risk for the company because of no obligation to pay the dividend. Then, in terms of returns, the debt holders willing to accept lower returns due to lower risk. So, consistently, they would get their amount, even if it is at a lower percentage. The cost of capital is low. We've discussed that. So, in spite of the cost of capital being low, some investors come forward to invest in debt capital only because of the consistency. Consistently, they can earn that return. There is no variation. Even if there are no profits also, their amount is ensured they would be paid. So because of that reason, we see that the debt holders are willing to accept lower return due to lower risk is also low. So for the company it is also benefit because it is at a cheaper rate. So it would be continuously meeting this capital, uh, this uh, cost cost of interest. It has to meet and pay to the existing debt holders. So from the company's point of view, it is a cheaper form of capital. The next one is the return part of it. For the equity, shareholders want higher return to compensate for higher risk. Why would they see that the risk is higher? The risk is higher. Just now we mentioned that equity is low risk for the company. Just now we've mentioned it is low risk for the company. But right now, again, we are talking about that shareholders want higher return to compensate for higher risk. For the company, it is low, but from the shareholders' point of view, the risk is high. Therefore, because the risk is high, they are taking up higher risk. Their expectation, of course, it is not that they are promised at the time of issue, but their expectation from the company is for higher return. So their expectation is they want. That's why it says that they want. It's not that they are paid. They want higher return to compensate for higher risk. So this is from the perspective of a shareholder. From the company point of view, they have low risk, but low risk for a company, but they are always under an obligation to see that their profits are high. Okay, so it is more expensive for the company because directly there's nothing promised to pay them, but it is they are under an obligation to pay them a higher dividend, um, because they do not want to cause any dissatisfaction among the shareholders. So they take it as a responsibility to earn higher profits and distribute these higher profits to the existing shareholders. So on that note, we see that it is more expensive for company. I hope I'm clear. Did you understand the difference between debt and equity? Okay.
Yes, ma'am.
Okay, it should register in your mind forever. Forever, entire lifetime, you have to remember. There should be no doubt or any kind of. um, um, I mean, confusion. There should be 100% clarity in your mind, because that's the base for financial management. What are the two sources of capital? The two main sources of capital are debt capital and equity capital. The features, attributes, the other aspects, all of them you have to remember it thoroughly. There is no sense of confusion at any given point of time that a finance student should have. Then financing for small and medium enterprises. Small and medium enterprises, um, they have difficulty raising finance. So why do we mention that they have difficulty raising finance? So big industries, the big companies, those which are large in size, for them to raise the capital, it would be easy because of the characteristics, their position, their profitability, their performance. It, for them it becomes easy to raise capital. But the small and medium enterprises, SMEs, what we call it as, it is not easy for them to raise capital. So we see that SMEs can have difficulty raising finance, because the financial institutions, the those people who lend money to such small size enterprises, they do not understand whether they would be able to uh, repay their amount on due dates. So because of that reason, many financial institutions do not come forward to extend the loan amount to small and medium enterprises, SMEs. So SMEs can have difficulty raising finance. Small number of owners with limited capital. Capital is also limited because it's contributed by few people. But whereas uh, in a company, we see that more number of investors are contributing their capital. So here in this case, number of owners with limited capital. So later on, to recover the amount also uh, from the company, it may become difficulty for the financial institutions. So small number of owners with limited capital. Then we see lack of business history and proven track record. Their past performance also does not indicate about they performing very well. So lack of business history and proven track record. Then we see lower level of scrutiny of accounts. So the accounts, because they only few investors have come forward to invest in that. They have less number of owners, and their liability also will be limited until their capital. So the um, to watch for the performance of the business, and to ensure that their capital amount would be paid back, um, to be sure about their capital amount invested in the company. um, and because of that uncertainty, then many investors do not come forward to extend funds to the small and medium enterprises. Their proven profit record is not there. Okay. Lack of business history and proven track record. For all these reasons, we see that the financial institutions do not come forward to extend their amounts to small and medium enterprises. Then we see maturity gap is where it's easier for SMEs to raise long-term finance secured against long-term assets. So in such case, we see that what is the liability? Liability is something which has to be paid, but they also, the secured liabilities have a claim on the assets. So in case of any difficulty paying back their amount, they can have a claim on the asset, that that asset can be converted into cash to meet their liabilities. So all liabilities, we see that they have a claim on assets. If they do not have any claim on assets, then we call such liabilities as unsecured liabilities or unsecured loans. So here we see that maturity gap is where it's easier for SMEs to raise long-term finance secured against long-term assets than the shorter-term finance that may be preferred. So um, it is preferred to have the funds invested for shorter period of time rather than waiting for a longer period of time, having a claim on a long-term asset and then recovering back their amount. So that looks uh, not so very interesting for the institutional investors. So they may not see that it is beneficial for them at that point of time. So maturity gap is where it is easier for SMEs to raise long-term finance secured against long-term assets than the shorter-term finance that may be preferred. So in a short period of time, it is always safe for them to get it back their amount within that short period of time. Have they had it been that they have to wait for a longer period of time because of that unsurety, they do not generally come forward to invest in these things and invest it for a longer period of time. Then sources of finance for SMEs, we have business angels, venture capitalists, government assistance, supply chain financing, and crowdfunding. So anytime when time permits, we can also look into the various attributes and features of each of these types of finance. That is sources of finance for SMEs, business angels, venture capitalists, government assistance, supply chain financing, or crowdfunding. The next concept what we have is Islamic financing. What is Islamic financing? Islamic financing, we see that interest is prohibited in Islamic financing. So we have this type of financing wherein we call it as Islamic banking. For any amount which is raised, there is no interest paid. Interest payment is not there. So any amount which is borrowed, lended, the concept of interest is not there. So then how does it work out? Instead of interest, instead interest is replaced with cash flows from productive sources. So they are entitled to receive a part of the profit. So they do not get interest, but they are entitled to receive a cash flow from productive sources. Cash flows from productive sources such as returns from wealth generating investment activities. So they are entitled to receive a part of the profit, but they do not collect anything else, as interest. So what is the difference between these two? Interest would be a fixed obligation. We've already discussed about that. Interest will be a fixed obligation irrespective of profitability. But here, if they are receiving a part of the returns from wealth or from investing activity, a part of the cash flows are received. It indicates that in situations where there are no profits, no cash flows available, they will not be entitled to receive anything from them from that situation. So here we see that Islamic banking is prohibiting finance, the interest on finance, but the investors can have a share from the wealth which is generated because of the amount which is invested. In an Islamic bank, the money provided by depositors is not lent but is instead channeled into an underlying investment activity. So it will be considered as if they have invested in that particular activity, in that particular business. It is not that they are lending amount and the company is borrowing from them, and instead of looking at that and paying an fixed interest, so because interest is prohibited, they as against the investment made, they can receive a profit or a share of return, because the funds will be channeled into investment activities. On their behalf, the investment will be taken up, uh, which will be channeled into an underlying investment activity, which will earn profit. The depositor is rewarded by a share in that profit after a management fee is deducted by the bank. Okay, there are certain other terms also. You can just have a look into that. Maraba, Marbaha is trade credit. Um, Ijara is lease finance. Sukuk is debt finance. Mudaraba, I'm really sorry. Mudaraba is equity finance, and Musharaka is venture capital. So we will see about angel financing, the venture capitalist. Some other class, I will explain to you the attributes of the characteristics of those types of businesses. Is that clear till here? So then we can start with the dividend theory. Is it clear till here?
Yes, ma'am.
Any?
Yes, ma'am.
The next topic, what we are going to start now. Is the recording not going on? I see that it was not there. When did it stop recording?
Ma'am, on our screen it is showing that it has been recorded.
Now I clicked it, but suddenly when I looked into that recording icon was not there. So
I think, ma'am,
Ma'am,
when
might
we started with dividend theory, the recording is not there.
beginning I have clicked on. That's why it's showing resume recording. I have started recording at the beginning. I don't
might be due to storage issues. Sometimes it also happens.
automatically it got. I think. Any doubt you have also, you can approach me if there is anything which is not there in the recording. I don't know when it got disconnected. I'm really sorry about that. Okay, but nevertheless,
No issues, ma'am.
from now it will be there. I do remember starting the recording at the beginning of the class.
No issues, ma'am. It is technical error.
Yeah, yeah.
Need to worry.
Okay. Um, the next one is estimating the cost of capital, the dividend valuation model. The dividend valuation model, estimating the cost of capital. So it is based on um, the cost of equity capital, because we are talking about the equity dividend, whether it is paid or not. The relevance or the irrelevance theory is what we are basically talking about. So the cost of capital, estimating the cost of capital, and the valuation, the dividend valuation model, valuation of the firm. That is what we are looking at. The current share price is determined by the future dividends discounted at the investor's required rate of return. That's the first part of it. The second part of it says that the cost of equity is equivalent to the shareholders' required return found by calculating the IRR of the investors, cash flows of the ownership of the shares. So what is the cost of capital? So cost of equity capital is calculated as periodically periodically they would be receiving the dividend amount. So dividend, okay, for how many years? A number of years, infinity. Okay, for an indefinite period of time, dividend would be received. Fine. dividend would be received, but because that would be received in the future, that has to be discounted as on to the present date, because the present value, because the cost is calculated as in the present value of all these cash flows have to be calculated. But since it is because of a indefinite period of time, the discounting part of it will go as, they have to be discounted at a given rate of return, or given discount percentage. So we know that if it is for an indefinite period of time, okay. um, so the value of the present value of the cash flows, that is in the form of discount, they are discounted at a percentage of interest, sum total of all of them, I mean the sum total of all the cash flows for an indifferent period of time in one simple go, when it is calculated as the present value of um, the the cash flow dividend, we have this one calculated as the current share price is determined. I wrote this one as the current share price should be accounted as current share price at the 0 year. I'm really sorry for writing it wrong. So the current share price in the current period, which is 0 period, is equal to all the dividends which are discounted at R percentage. Fine. So the cost of equity is equivalent to the shareholders' required return, found by calculating the IRR of the investor cash flows of ownership of the shares. So dividends, since they will be paid in perpetuity, we see that dividends are constant or growing at a fixed rate. So that part of it we'll discuss. So if R or K, both of them, R is a return, the term, and K is the minimum return which they have to earn. So if at all, if we have to calculate what is KE, KE goes to the other side. We have the amount of dividends divided by PU. That is how the valuation or the cost of capital is calculated. The present value of all the dividends is calculated as the dividends for an indefinite period of time are discounted at the cost of equity or the rate of return. If we are finding out what is the cost of equity, we calculate it as D by PO. The logic for D by PO is, if PO is the current investment which they are making, which is 100%, the all the dividends which they are going to receive, the present value of all the discounts is what percentage. So that is how we calculate what is the cost of equity. That is how the dividend valuation model talks about what is the cost of capital. Here we are assuming, there is an assumption that D is a fixed amount. Every year they would receive the same amount. If let's say that the first year they receive a dividend of $5, for n number of years, for an indefinite period of time, year after year, their dividend amount would be the same $5. So that is one assumption. Okay. So in that case, this equation holds good. KE is equal to D, which is the fixed dividend, upon the current price. So D by PO is the, the cost of capital. But we do not see this happening. That is, that fixed dividend being there forever is a very rare situation, because as the profits keep growing, we see that the returns also grow. The amount of profits which are earned by the company, when they are growing, we also see that the profits also the dividends also grow along with the growth in the profits. So dividends are constant is one aspect. Here this is applicable, or they are growing at a fixed rate. So what does it mean if they are growing at a fixed rate? So we see that the dividends are growing at a fixed growth rate. So we see that this will grow. Then we have to calculate the discount part. Okay, the present value of that would be dividends are growing at a fixed rate and discounted at cost of equity. So that would be the present value. Present value of all the cash flows would be the dividends which are growing at a fixed percentage. So D into 1 plus G divided by K, cost of capital. Cost of capital is used to discount the present So we have the cost of equity given as constant dividend, same dividend year after year. We see PO is equal to dividend divided by RE or KE or return or cost of equity, whatever is the variable which we use. The meaning of it is we are discounting all the dividends from the first year until the nth year, which is for an indefinite period of time, discounted at the rate of return, which is RE. So PO is equal to D by RE or RE is equal to D by PE. RE is the cost of capital, PO is the present market price, the ex-dividend market price of the share, D is the constant dividend. Then when if they are expected to grow, when they are expected to grow, we see PO is equal to D1 by RE minus G, okay, or RE is equal to the logic here is what is the present value. So how are we calculating the discount which is growing? We didn't write D, we wrote it as D1. So how will what is the relation between D and D1, DO and D1? D1 is equal to whatever is the last dividend, DO into 1 plus G. Because it is growing, it is more than what they were entitled to in the previous period. So DO into 1 plus G gives us what is D1. So henceforth we are only depending on adding up a growth margin. So there is a growth margin which is added to the existing amount of dividend periodically. Year after year we would see that it will grow at 1 plus G. So now the concept is when there are more profits, when there are more profits, when there is growth seen, that's why dividends are also growing. When there is a growth seen, that more amount of profit will reduce the cost of equity. So the burden on earning a minimum return that keeps coming down. So that is the minimum return which the company has to earn is lightened by that percentage of growth, because more amount of invest, more is the profit. So that obligation to earn a minimum return, which is RE, the cost of capital, the burden of that cost of capital lightens by RE minus G. So PO is equal to D1 by RE minus G, a constant rate of growth in dividends. The constant rate of growth in dividends. So that is reducing the cost of capital, RE minus G. So when we present what is RE minus G goes to the other side, P0 comes here. So RE minus G, the equation will be, if we take RE minus G to the other side, is equal to, we have it as D1 by P0. Send G to the other side, so it becomes RE is equal to D1 by P0 plus G. That's how the equation has come. RE is equal to D1 by P0 plus G. But D1 is after adding a growth margin to the past period. So the last period, whatever was the dividend amount, because the profits are increasing, dividends also increase at that fixed growth percentage. So D1 is equal to DO into 1 plus G. So D1 by P0 plus G. G is equal to constant rate of growth in dividends. D1 is equal to dividends to be paid in 1 year's time. So 1 year's time, 1 year later, it will be paid more than what it was paid in the present period. So how do we calculate what is estimating growth rate? How do we calculate growth rate? Calculating growth rate is also very important. How do we calculate? How do we calculate the averaging method? The equation G is equal to under root n. Under that we have current dividend by dividend n years ago. Okay, minus 1. This is the averaging growth rate, but we need to remember the Gordon's growth rate model. So technically we will be tested with the Gordon's growth rate model. The logic behind Gordon's growth rate model is, we have looked at this income statement format at the beginning of this class. What did we look into this? We have understood that this is the amount of profit which is available to the shareholders. Out of that, only one part of it is paid. Only one part is paid, and the rest of it is retained in the business. What is the purpose behind it? So that it will go for reinvestment. So this reinvestment is causing the growth. Reinvestment is causing more amount of profits to happen. So when there is a possibility for more amount of profits, we see that growth is happening in the firm, in the company. So growth is possible because of reinvestment. Reinvestment is because of retained earnings, because earnings are available and earnings are retained. They are available because they are retained, not distributed to the ordinary shareholders, that they are available. What is the purpose behind that? So that they can be reinvested. When they are reinvested, they earn return on the reinvested amount also. That is the logic here. So let's get back to the PPT. So growth is calculated as an equation which is given as G is equal to R into B. G is equal to RE into B. So B is the a portion of the funds which are retained, the profits which are retained. B indicates that portion which is retained in the business. Retained investment, retained earnings are reinvested. So reinvested funds are earning a return at the rate of RE. So reinvestment into the rate of return gives us what is the growth rate. So this is the proportion. B is the proportion of the funds. Let's say if 100% of profits are available, proportion we are talking about, not the total amount. If 100% profits are available, so profits available to the ordinary shareholders is taken as 100%. Okay, this is profits. Out of that, let's say the equity, the ordinary dividend which is paid, is, let's say, 40%. So what portion of the funds are retained in the business? 60%. So the retained earnings proportion will be 60%. So it can be written as, if we are taking percentage wise, 100% minus the percentage of ordinary dividend which is paid, okay, is the proportion of retained earnings. Or we can also write it as the whole is taken as 1 minus the dividend percentage. That also can be taken as retained earnings proportion. B is equal to that portion which is retained. Why is it retained? It is retained because it has to be reinvested. So once the reinvestment amount is made on the investment, whatever is the percentage, the investment proportion into the rate of return percentage calculated gives us what is the growth rate percentage. So we go with the second one most of the time, but one type of calculating the growth rate is the averaging method, because it extends for an n number of years. So it's taken as nth root. Under that, we have current dividend by dividend in n years ago. N years ago, the first year, whatever is the dividend which is received, and the current dividend. So they are compared. So the first period, if it is 100%, the current period is what percentage? Converting it, um, finding out the nth root, from that minus 1 gives us 1, because we are converting it into 100%, or 1, we are taking the base to be as 1. So from that we deducted 1, so we get what is the value of G. That is one method. That's about cost of equity capital. Then we also have to learn about the cost of debt. How do we calculate cost of debt? What is the main cost in case of debt capital? Interest is the main cost. Okay, interest is paid on the debt capital. Here there is a classification given about what are the types of debt. There are redeemable debt and irredeemable debt. We see that irredeemable debt are kind of very rare, because outsiders do not want to wait for an indefinite period of time, so they do not generally get attracted to irredeemable debt. They only are looking at earning a return for a specific period of time. They want their investment back so that they can be reinvested in some other investment opportunity. So very rarely we see that, but that is also a situation where once the outsiders invest their amount, that will be there with the company until the winding up of the company for an indefinite period of time. So that is also there. Then redeemable type of debt is after a specific period of time, the investment amount is paid back to the debt holders. So we see there are two different types of debt: irredeemable debt and redeemable debt.
Excuse,
I'm
ma'am.
taking, yes, ma'am.
Ma'am, can we do this topic tomorrow? Actually, we are not able to gain much more.
Okay, 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 okay.
If there are no issues.
No issue, no issue. Any doubts? I know the content what is delivered is. In fact, actually, I was supposed to start this one. I felt that this is little on an advanced level. I thought cost of capital may seem much simpler, so that's why. What do I do?
Okay, ma'am.
You want to work out any question, or we'll take it up tomorrow?
Ma'am, tomorrow actually we are not able to gain more today.
I understand. I perfectly go with you, because the topics are also at an advanced level only. Okay. Um,
Yes, ma'am.
Maybe I'll start with working out few questions from the exam kit and then continue further. Okay.
Okay, ma'am.
Okay.
Okay, ma'am.
Okay. Then good day. See you tomorrow at the same time.
Thank you, ma'am, and sorry for
No issue. I think all the students echo with that, because it is not only just one student. I'm assuming all of them have the same view.
yes, ma'am.
Is that fine, student?
Ma'am,
Okay. No,
yes,
I mean to say that I assume that all of them are comfortable with this particular thing that will continue tomorrow, because we still have another 10 to 15 minutes time. So that's the point. Okay, we'll adjust it in other classes, or maybe we'll extend it by 5 minutes and then adjust it. Fine.
Okay.
For today, we will wind it up. Fine. Okay, then.
Thank you, ma'am. Thank you very much.
Good day.
Good day.